Let me, yeah. A very good afternoon, East Africa. It's a beautiful day to be alive, and particularly a very wonderful day to be an East African. My name is Gabriel Achaye, and I am speaking to you live from the East Africa Law Society Secretariat here in Arusha, Tanzania, for this very exciting webinar on mergers and acquisitions in East Africa, emerging trends, regional dynamics, and global influences. This afternoon, we have brought together legal practitioners, industry leaders, and regulators to explore the opportunities and challenges and to share practical insights that will shape the future of business consolidation in our region. It's my pleasure now, ladies and gentlemen, to introduce my good friend and classmate, Mr. Leon Amuthere, who is an advocate of the High Court and seasoned corporate and commercial law practitioner. He currently serves as company secretary at Vartus Global Security Company Limited, where he provides strategic, legal, and corporate governance support. His expertise spans mergers and acquisitions, regulatory compliance, contract management, and corporate advisory, and is widely recognized for his professionalism and commitment to ethical legal practice. So, with this rich experience, Leon is well placed to guide us through today's discussion. And so, please join me in welcoming our dear moderator, Mr. Leon Amuthere, to come and take on this session. Leon, it's so good to see you once again. Karibu sana, and I know particularly for you in Kampala, you must be excited following the Uganda Cranes victory last evening. But on to the session. Yeah.
Thank you very much, Gabriel, for those kind words. I don't know whether I'll be able to live up to that expectation, but I will do my best. Good afternoon, distinguished panelists and participants. It's a pleasure to welcome you to today's session on mergers and acquisitions in East Africa, emerging trends, regional dynamics, and global influences. We are privileged to have with us some of the best experts in the field who will share their insights and experiences. Now, I know mergers and acquisitions can sometimes sound like heavy boardroom talk, but I promise today's conversation will be lively. After all, we are not here to negotiate a deal. Our program is straightforward. Each panelist will have 10 to 12 minutes to present. We will then open the floor for audience questions and reflections before wrapping up with key takeaways. I encourage everyone to engage actively, ask questions, challenge ideas, and connect the dots between global trends and regional dynamics. With that, let's get started. I think let's begin with our first panelist for the evening. I'm going to invite Mr. Stephen Kimwetsje, if you're ready, to open up the discussion. Thank you.
Thank you, Leon, and good afternoon, everybody. Good afternoon from Kampala. It's a pleasure to be joining this session. But perhaps my presentation is on, the starting points of mergers and acquisitions, which is the SME and startup seeking to consolidate and grow. So I'll be making my presentation on that area, and then my colleagues will come in with other presentations, but I'll share my screen and then we can take it on from there. Yeah, I hope I can be heard very well, Leon.
Yes, we can hear you perfectly.
All right, excellent. So, again, as introduced, my name is Stephen Tumwesige. I'm a partner at Taslaf Advocates. We are a mid-sized law firm in Kampala that provides support to investors, SMEs that are looking to expand in the area, and also participating in some acquisitions and mergers from an advisory perspective. So the ELS asked me to make a presentation on SME mergers and how local businesses can be empowered through consolidation, and the trends around the East African region on the role of SMEs and the role of lawyers in sectors such as agribusiness and retail, and how this has helped build the entire entrepreneurial ecosystem, and how that can be brought together more through consolidation and growth. So my presentation will cover perhaps 7 areas, sort of the market context and the drivers for SME and M&A growth. We'll look at some sector spotlights and case studies. We'll look at what roles lawyers can play in this industry, the key takeaways, and then a discussion and Q&A at the end. I hope I can fit within the 10 minutes allocated to me. So really, I think this conversation is very important because we see a lot of SME mergers and acquisitions in East Africa. And according to the YAVCA, East Africa lodged around 95 acquisitions in Kenya, Tanzania, and Uganda over the past 1 year. And many of those were focused on healthcare, retail, finance, and ICT. Also to note that private equity remains a key driver, accounting for 37 deals in East Africa, which reinforces our confidence in our market in the East African region. Why this matters for lawyers, for us as lawyers and the East African Law Society, obviously mergers unlock scale, they create capital access, and of course, regional reach. So you have acquisitions that take on 3 countries, or mergers that then take on interests around the 3 or 4 or 5 East African countries. So there's unlocking scale, capital access, and of course, regional reach. This has a result created a regional demand for lawyers in, skilled in structuring, compliance, DD, integration, etc. So this is an extremely important area and a growing area really for lawyers. Again, we see an increasing demand in the PE space. You have every year new investors coming into the PE space with strategic investor activity. And of course, SMEs that are looking to scale, create supply chain resilience, and of course, create market reach. But also in the tech space, you have the growth of digital platforms that are merging offline and online industries with a need to cause for integration. As a result, these sectors have caused for sector consolidations, which then results into what we have as mergers and acquisitions. I think one of the key areas we see around the SME space has been, that has been attracting a lot of interest is the food processing and agro-processing sectors, especially in the poultry and other industries. Obviously, these sectors are, capital intensive with the need for land, machinery, etc., and therefore there's a need for consolidation opportunities. As a result, many SMEs have been combining operations for economies of scale, and as a result, investors have been coming in. But of course, investors are demanding for, formal governance, clean books, strong contracts before committing capital, which are areas where lawyers can directly add value. There are a few sector spotlights, but I won't be going through those. But you have health health tech and retail pharmacy coming together. I think all of us know the story of Mydawa acquiring Guardian Health in Uganda and Rocket Health, which was a telemedicine platform. One of the key areas where you see consolidation in the sector. As a result, there's a rising demand for, accessible healthcare, especially, and increased mobile penetration. I think all of us are noticing the growing trend in telehealth, e-pharmacy growth. As a result, investors are interested in that and areas that are scalable. What we see as the legal complexities or where lawyers can participate is in, the need for licensing in multiple jurisdictions, requirements for DDs, data protection, cross-border logistics, and of course, medical practice areas like controlled substance regulations, and obviously employment harmonization after acquisition. So those are the areas that we see. I'll just skip this quality chemicals. I'll come back to it when we're having the Q&A. But I want to go to the role of lawyers in the interest of time. I think in the SME life cycle, where a company is trying to either secure capital, go into an acquisition, or merge with another, you have lawyers playing a huge role in the following. Number one, origination, which is due diligence checks, regulatory mapping, risk analysis, IP and land title checks, etc., etc. So origination, at the stage of origination, there's a big role to be played by lawyers. At the transaction level, you have lawyers drafting term sheets, competition filings, and other agreements. Obviously, post-deal integration, which involves employment harmonization, contracting, licensing, and of course, tax advisory and compliance. And at the point of when these enterprises grow, and I'll speak about the issue of the case of Cipla, which started as a small entity in Uganda, but then grew to be listed on the stock exchange. And I think my colleague, William or Jonathan will speak about it. You have, at the point of either, debt is being converted to equity, you have initial public offers, or a strategic reorganization. All that requires the role of lawyers. Obviously, at the point of distress, lawyers come in to do restructuring, insolvency, and creditor negotiations. So what we see for lawyers, starting out in this area, we think that the following can be very helpful as entry points for SME work that could result into mergers and acquisitions work. Partnerships with incubators, acceleration programs. All of us in our countries and the respective East African countries, we have, innovation hubs and other accelerators in the entrepreneurial ecosystem. So these can be useful for lawyers to generate leads by offering legal clinics, legal boot camps, and for accelerator cohorts who then you become their go-to person for such work. Again, providing template starter packs for hub members, simple agreements, etc. And obviously offering seed legal services for SMEs, even before they get the investor and go into the scale. So again, as we go into this conversation and as my colleagues will be sharing, SME mergers and consolidations are, of course, strategic growth drivers for the economy. And obviously, every large industry behemoth was at one point an SME. We see a lot of growth in the agribusiness, retail, health tech, which are leading the consolidation sectors in East Africa. And of course, lawyers must come in to demystify M&A for SMEs, create structure, compliance, and governance. And of course, work in partnerships to empower the SMEs to be merger ready. Yeah, so I'll stop there for now and let my colleagues make their presentation, then come back with the Q&A. And if you a few case studies that we have covered. Thank you so much, Leon.
Thank you very much, Stephen, for this insightful discourse, especially for highlighting the critical role of the lawyers in the process. We know that the audience is running with questions, and we kindly invite you to hold them until the Q&A session, when the floor will be open, and then we can have a more insightful discussion on the same. At this juncture, I'm going to invite Catherine. Catherine, are you ready? Yes, Catherine, the floor is yours.
Thank you, Leon. Thank you, Leon, and good afternoon, everyone. I'm glad to be here this afternoon. My name is Catherine, as Leon mentioned, Catherine Kariuki, and I practice from Nairobi. I practice in a law firm called Coventry's. I'm an advocate based out of Nairobi. It's a specialist law firm, and we specialize in supporting clients in specific tech sectors, which we call TDFI, which is tech, telecoms, data, fintech, intellectual property, and innovation. And what I'm going to cover this afternoon is to just add to what the first speaker has, or to build on to what the first speaker has provided. I'm going to provide insights into, what makes East Africa's tech and fintech attractive, and where are deals coming from in when we talk about tech-driven M&A in East Africa, and really what's moving the market. To just give insights so that lawyers can be able to see where to plug in and how to position themselves in this market, and especially if you're interested in the specialization, like in the sectors that we cover as Coventry's. So basically, to start off, I would say to just cover the legal steps and actually what gets deals closed in our market, and what makes entries and exits in our markets succeed. To cover why the ecosystem is vibrant, and why it matters for mergers and acquisitions. We, as East Africa, I'd say we have a strong tech base, and that has attracted a lot of activity when it comes to M&A in East Africa. Particularly in Kenya, I'd say we have the startup community that has really grown over time, and it's grown around places like iHub. I think the first speaker has mentioned about us positioning ourselves as lawyers to support hubs, because these hubs will then house a lot of the startup community. So you're able to plug in and to even support them, because as he mentioned, a startup will start today and then tomorrow it will get investors or will be acquired. So if you position yourself early enough and start supporting this startup community, then you're able to plug in, and as they grow, then you're able to tap into them as they grow, and you can support them in their whatever M&A activity that is going to be there, whether they're going to be to get investors or financiers. You're able to tap into that and grow. So that's one of the things that I'd mention. I'd say, yeah, as I mentioned, East Africa has a very vibrant hub of startup community. And I think in 2019, we saw Nigeria's CC Hub, or what we call the co-creation hub. They bought Kenya's iHub. We saw them buying into Kenya's iHub, and that was a very interesting for us in this community who, are always following what's happening in the industry, because for us, that wasn't just a brand move. Basically what they were doing is they were combining talent, IP, and a community, because they got an already existing community. And that already existing community is expected to produce the next set of targets and buyers. So that's why they didn't come and set up a separate hub, but they bought into an already existing hub. And that integration across ecosystems is what we're seeing a lot of M&A activity looking like now, because then for that example, it already feeds into future deal flow and they don't have to start from scratch. Second, the other aspect that we are seeing in East Africa, and particularly in Kenya, we're seeing a lot of like people considering that digital rails everywhere. And by digital rails, I mean this layered kind of industry, especially in our TDFI industry. There's a lot of layers where you'll find people are regulated in different aspects. So you'll find like there's a bank or a community that needs a lot of integrations in order to just be able to launch one product. So you'll find there's an aspect of mobile money, a lot of backend PSP. You need to integrate with what we call a payment money, PSP, payment services provider. You will need to integrate with a mobile money or a mobile MNO, a mobile network operator. A lot of other fintech companies integrating into one particular leading into a lot of like partnerships. So it's one product, one particular partner, but you'll need to partner with so many people. And therefore, in an M&A where you're acquiring such a company, you'll find that in the back end, there are so many integrations. So then there are so many digital rails everywhere. So we're finding people referring, instead of coming and setting that up from scratch, they just coming into the market and identify people who are already licensed and acquiring that. So we are finding a lot of preference when it comes to that. And if you think of our industry, you'll think about, there's a telco industry, there's a lot of data center activity, there's a lot of payment assets activity, and a lot of fintech activities. So we're seeing a lot of that example. So, for example, I know many of you must have seen IFC, where IFC injected 100 million financing into the Raxio group to expand centers that power cloud AI payments across the region. So that already gives you an indication of what the preference is and why such huge players are looking into the market and looking for people who are already existing, because they already have these digital rails already set up. They prefer an already set up entity to just plug and play. And so we're seeing a lot of that, as opposed to going and looking for someone or setting up from scratch, or someone who's not yet, figured out the licensing bit or the integrations bit. So then I'd say also around East Africa, rules are becoming clearer, and that's becoming very attractive to the DFI market. And by rules becoming clearer, I have in mind, like, for example, the digital credit providers in market in Kenya, where the regulator brought them under the scope of regulation, where before they were not regulated, but then the regulator brought them under the scope of regulation, and now it's clearer what is expected of them. Actually, as we speak, just in this month, the CBK released the non-deposit taking digital credit providers regulations, which seeks to repeal the existing digital credit providers regulations and amend that and provide clearer expectations or clearer rules that are expected for the digital credit providers community in Kenya. What it means for those looking at acquiring businesses in this sector is that now it's more clearer, and as they are investing, so now they'll be able to, the businesses in these industries will now be able to attract more investment in this sector, which is a good thing. So around East Africa, we're finding the rules are becoming more and more clearer, which is attractive for investors. And the other thing that I'd point out is, I'd say regional merger control is also stepping up. I'm sure most of you as East Africans have seen, like, the most recent one, which was the EAC, East Africa Community Competition Authority. which is now will start taking merger control notifications for cross-border deals in November this year. So that consolidation again is becoming better and more attractive for investors outside or financiers outside, which as a region, it's positioning itself better for the M&A activity community. Again, for the sectors that we advise, because they are very specific and are almost always regulated, all these things, there's an aspect of regulatory mindset, and you'll find that the regulators around East Africa have a very good and facilitative and supportive, mostly, I'd say mostly, maybe not all of them, but mostly, they have a very good regulatory mindset, which, for instance, a regulatory mindset that entertains collaborative and innovative approaches towards, say, let's say, new product launches, new business ventures for its licensees. And that really influences a lot of growth in the market, such that people are able to launch, sandboxes, people are able to engage regulators on what their products look like, so that the regulator is able to go and sit and see what guardrails needs to be put in place. And I think that has assisted the market itself in terms of being quite attractive for M&A activity. I'd say in terms of, again, TDFI, this industry, when we look at inflow map, where is most of the tech or fintech M&A into East Africa coming from? That's something else that we've been able to analyze. And I'd say the main streams for the last maybe 2 or 3 years, there is the aspect of the Pan-African strategics, which is quite interesting because we've seen a lot of Pan-African activity where, it's one African country investing into another African country, and, where they'll come into the market and buy capability or licenses. And maybe one example that I can give is where Moneypoint invested 78% into Sumac Microfinance Bank in Kenya, which is a fintech that's now stepping into a licensed balance sheet, scale credit and deposits locally. There's also the aspect of, like, for example, a regional bank buying a fintech rail. As I said, there are so many aspects of one product can tap into so many aspects. And therefore, we've seen a lot of banks buy into fintechs where they don't want to build internally. You just buy an existing fintech company that already has a license and a business model. So, for instance, we saw KCB Group invest 75% or acquire 75% of Riverbank Solutions, which is a payment infrastructure and digital distribution. Then they were able to bring that under the ambit because sometimes the regulated entity itself as a bank, there's only so much it can do. And there are guardrails because, again, it's a licensed and regulated entity. So they were able to do that. Then we also saw, we've seen quite a lot of activity where there is now, outside Africa, investment and a lot of investment coming in. For instance, there's a Shifao Healthcare that we just saw where Leapfrog exited from Good Life Pharmacy. We had seen them come in a few years back and finance an expansion plan, and now they exited, and Shifao Healthcare was able to come in. And Shifao Healthcare just moved from minority. They were already a shareholder, but they moved from minority shareholder into full control. That's also another aspect that we are seeing where people are increasing their shareholding. And then another aspect that we've seen is where DFIs and infra investors are enabling what we call pick and shovels. So like the one that I mentioned for IFC, where it invested 100 million into Raxio data centers. Then what I'd mentioned is, I think we'll cover that in the pain points that we've seen people, but I'd like to mention something that's important, which is the policy sensitive situations. So we had a situation in Kenya a few years back where we have Telkom Kenya that saw its ownership. There was a PE fund called Helios, and it tried to exit. It exited Kenya, but a lesson to be learned by lawyers is that in all deals that you're structuring, you need to consider policy sensitive situations, because then that raised, I'll cover it later, but it raised quite some issues when it came to the political issues, where at some point the deal was even cancelled and they tried to reverse an earlier buyback by Helios. I'll cover it later. But in terms of case spotlights, which are the practical examples that I'd like to add. I think I've covered most of them, but I'd like to highlight tax. I think the earlier speaker has mentioned about the aspects as lawyers that, where we will be needed to tap in. One of the things is tax, and tax in case of mergers and acquisitions is so sensitive. So I'd like to highlight it. And in Kenya, we saw a case, Naivas Supermarket. There was a tax case where Kenya's Tax Appeal Tribunal held that a Mauritian holding company tied to Naivas was managed and controlled in Kenya. So it was, the local, I'd say, operating company, which was Naivas, was appointed a tax representative to a larger corporation tax. So it really implicates your structuring and how you structure at the initial point. And if you don't structure it well, it could really land the client, or if you give an erroneous legal opinion, then it could land your client and yourself into a huge mess, or in huge problems, where the client can even accuse you of being negligent in terms of your advisory. So I wanted to highlight that. And one of the big things that I think that I see clients relying on an M&A lawyer is, for instance, if you're advising them to, enter the market, they're entering the market by way of, an acquisition, an investment, and advising, then you have to advise them to pick the right entry route, because they'll probably rely on you end to end. So you have to, by picking the right entry route is, for instance, if they're entering a regulated market, you have to let them know from the word go that they're entering a regulated market, and do they, prefer to apply for the licenses themselves from scratch, or do they prefer to buy a licensed entity, because then that influences what they're going to do after that. The things like you have to be careful so that they don't launch. For instance, they launch a product with maybe a lending or a wallet feature, and probably say it's just tech, while at the end of the day, it's a licensed. That is a nice licensed business. And therefore, they'd get into problem if the regulator would find such a product in the market. So you have to consider that. And then the other thing is you'd have to make an approvals calendar. Most of these regulated businesses, you'll find that there is a multi-regulatory approach when it comes to seeking, approvals. So at some point, you might find yourself even dealing with 4 regulators. It's ODPC on this end, it's probably Central Bank of Kenya on the other end, it's CAK on the other end. You might need COMESA approvals. Now with EAC, with the new EAC merger control regulations, then you might need that approval as well. If it's a regulated entity, if you're dealing with Communications Authority of Kenya, you might find yourself also needing that. So you have to build that into an approvals calendar, because if you don't do that, then the client will accuse you of, you're being all over the place, and you did not put real, dates and document them and advise the clients against them and against each item, so that they're able to plan and structure their timelines. The other thing which, as a lawyer, I'd say you'd consider is to our East Africa region is big on consumer protection, and those are the peculiarities now on the ground. You have to consider that and advise your client about it. For instance, a huge consumer protection considerations, like, all of us, I'd say most East African countries have the data protection considerations or consumer protection considerations and there will be policies at one time or the other. So that you have to build that into the deal, and as you're structuring it, so that it's tidied, and your products, the process, the products themselves are tidied before you even file, and so that your client is not going back and forth when it comes to regulatory approvals. Those are the things on the ground that you need to provide for them. Then I'd say you'd have to, the other thing that the clients depend on you is to design, the documentation for reality on the ground. For instance, the share purchase agreement. The condition precedents should mirror the specific, let's say, licenses, the permits, the data steps, and the exact merger filings. Because things like, long stop dates should match the slowest regulator, because again, we know the regulatory mindset. All the regulators in your region don't operate the same. Some are slower, some are fast, some are more accommodative, some are very strict, some are narrow-minded, some are, very open. And these are the things that you should now build into your advisory and, be able to advise that. You should also be able to advise your client even at the exit, in case they're considering, even as they enter the market, you should be able to advise them on the exit and how to exit successfully in our markets. Again, it's very peculiar to our markets. And there's that case that I, for instance, mentioned, the Telkom case, where there was political and policy considerations to have been made. There's no way that would have appeared anywhere on paper, but because you have local market knowledge, you should have been able to advise them of that, and how they can make a successful exit in the market. And there's what we call regulatory cleanliness, like for instance, you advise them on how to keep their licenses current, their filings, if they were doing any, sandbox testing, then the learnings were documented and things like that. And then there's always the data and IP clarity. There's a commercial durability. There's a tax and effect certainty, which is a huge deal. Then what I would point out, because I can see my time is running, maybe what I'd like to point out more on this is I have mentioned the different layers that you'd need to consider. Maybe what I'd like to highlight as I finish is I think I can handle the rest during the Q&A, because I can see my time has passed. But I think I've mentioned everything that a lawyer is dependent on, which is there's a pre-deal strategy and market entry. You will need to structure that. Usually, we also do the term sheet and structuring as lawyers, and then we do the targeted DD. It just means that you need to be the industry that you're supporting or the business that you're supporting. You need to be very knowledgeable about that business, so that even as you do the DD, you know exactly what you're going to look for in the DD. And then there's the aspect of the merger control and sector approvals. You need to be very aware of what triggers approvals and merger control. And for you also need to develop a relationship with the regulator, so that you're able to be able to provide these services seamlessly to your client. And then there is the usual actual transaction documents, which as lawyers you are required to draft. I need to mention that you'll find yourself as lawyers also working with other transaction advisors in a merger transaction, an acquisition transaction. You might find yourself working with a lot of, like, let's say, accountants, auditors, consultants being brought on board, and you have to also figure out, have good skills in project management, so that you're able to work with all these transaction advisors at the same time and be able to coordinate it seamlessly for the sake of the client and be able to deliver within timelines. So project management is always a huge deal, and it works very well if you're able to be a good project manager. And you're also expected to be very good in closing mechanics and, as in line with your project management. And I think I'll pick out the rest in the Q&A, and I'll hand over to the moderator.
Thank you very much for your submission. In an interest of time, I'm going to jump immediately to Jonathan. Are you ready? Jonathan?
Yes, I am.
Please.
I don't know if you can. Hello? I am ready. Can you hear me and see me?
We can hear you, but we do not see you. Yes, now we see you.
Okay. Good afternoon,
Yes.
everyone. My name is
Afternoon,
Jonathan.
Jonathan.
My name is Jonathan Shona. I'm a senior associate with F. Mpanga Advocates. Unfortunately, William couldn't make it, but he shared his presentation, so I'll just get into it. I'll share my screen shortly. And I hope you can see it. And in the interest of time, I won't run through the whole of it, but I will certainly highlight, the key points, key takeaways. I was asked to speak on global capital inflows, attracting and managing foreign investment, a sharp analysis of how international players from Chinese conglomerates to European private equity firms are influencing the M&A space in East Africa, and the legal strategies to manage foreign direct investments and complex due diligence processes. It's a mouthful, Leon and Gabriel, that's the whole conference. But anyway, so just a brief overview. As we would all know by now, China is one of the leading investors in Africa, foreign direct investment in Africa. And in East Africa specifically, it's, for so long, we've traditionally relied on the West, but China is increasingly, arguably, is now probably the leading investor in East Africa. Key to note that whereas, European private equity funds, have been involved in a lot of M&A or equity financing, debt financing. The Chinese have traditionally taken on the approach of, large infrastructure projects or things like lending towards that. They have not been involved in a lot of M&A work or P&E, at least not traditionally. Maybe in the more recent past, we've seen instances of, Chinese being, Chinese mining or energy companies. We've seen a few exits, but even those exits have been, taken over by other Chinese companies. So that's the perhaps peculiar trend with the Chinese investment. On the flip side, there's been, we've continued to see a lot of on the flip side, we've continued to see, a lot of activity from European investment. From European PE funds, in terms of, investing in sectors in the financial services sector, consumer goods, a lot of technology, renewable energy. So for a lot of the financial services, I think much of the activity has been, banking and finance and insurance services. Partly, this has been triggered in part due to the recapitalization regulations, especially in Uganda and Kenya. And similarly, in the insurance sector, there's been a lot of movement there with a lot of, greater mergers, the larger insurance companies coming together. I think for the financial sector, we've seen I&M in the recent past in Uganda and Kenya. And in Tanzania, we've seen Access Bank across the region and a couple of other banks in the region. We've also seen, Equity Bank expanding its reach in the region into Congo and Rwanda, South Sudan. So that's what we've seen in the financial services sector. We've also seen a lot of movement in the fast consumer goods sector. soft carbonated drinks, and the distribution of those consumer goods. We've also seen a lot of activity in the energy sector, especially there've been several exits in the small dams that were built under the Get Fit program of the World Bank Group. So that's been a lot of the activity. But even with that much activity, we'll all appreciate the rest of us East Africans that much of it has been mostly in Kenya. I think according to Biaka, Kenya records about 3 times more M&A PE activity than all the other East African countries combined. That is Uganda, Tanzania, Rwanda, Burundi, and the like. So that's something to consider. To think about a challenge for the rest of us East Africans. And also much of the activity has been much of it has been equity financing. There's been a bit of debt and a hybrid of both. So those are the key observations, analysis for both for China and Europe. If we're to counterpart, and if anyone that has dealt with either the Chinese or the Chinese investment or the European investment, you will realize that there's also a different approach to a regulatory approach for either side. The European investors, because this has been something we've been doing for a while, there's a kind of mindset that they do approach a transaction, which would be partly different from how the European investment would take off. The Europeans typically have a template that's been run through by English law firms for several years, and they'll follow that typically, and they'll lean more to what council will be guiding on. The Chinese may start with the reverse, with the commercials first, and then the regulator later. So that's something we've noted in working. But I'll just move to, and I won't get into the details, but the slides have the details of the numbers and everything. But I just want to go through throughout the M&A activity that we have seen, as the other panelists have mentioned. Some of the key themes that we have noted is the critical role of technology. First of all, tech. There's a lot of investment in technology. I think Catherine spoke much about that, but there's a lot of investment in technology, in the digital economy, as they call it. But also increasingly, technology is being applied throughout the M&A cycle. I'm sure we're all familiar with the vanilla virtual data room, and they're growing more. What's the word? More comprehensive, more complex. So that's something, as a lawyer, and I'm going to look now at the lawyer's role. As a lawyer, you have to keep up to date with that, the growing complexities of the virtual data room. And I'm sure there are now people providing that service, selling it across the board. So that's something one ought to be, as a lawyer, you ought to keep up to date with the evolving nature of the virtual data room. And the growing role of AI in the M&A space. You would all be aware now that there is AI technology and the different forms to review contracts. And from the commercial end of things, people are seeing this as a cheaper way, as a way to reduce legal costs in the M&A process. So the hourly rate that people are being happy to charge over time is being challenged if AI can review that document. So it behoves us as lawyers, one, to be able to, law firms may need to consider purchasing or learning or adapting some of that for their review purposes, but also how to work with it. Maybe AI could do initial reviews, and then, how do you follow that up for proofreading purposes and things like that. The other key things, especially if you're going to be working with PE funds, many of them now do have ESG requirements or obligations. So that's something that that is key for a lawyer to be aware of as you review documentation, ESG policies and things like that. But now also increasingly, and there are certain firms that are doing this, but also I think certain lawyers have been involved in also ESG due diligences to determine viability of transactions. Related to that is also climate change concerns in investments, when certain investments are more attractive because of their, it's able to earn an investor carbon credits and things like that. So that's another thing that we, as lawyers, we ought to be aware of and to keep in mind as we go into M&A. And these are things that are coming from, either European PE influences, and they're affecting the M&A space across the region. The other thing is cross-border regulation that's affecting East Africa. For example, regulation around anti-money laundering. Recently, Uganda was delisted off the grey list of the FATF, but also off the EU grey list. So that makes things, business easier in the region. Whereas some other countries have not been so lucky to be delisted. I think Kenya and Tanzania are still struggling with that. So that would definitely mean, financial transfers and flows, there'll be concerns for an investor around that. That may be beyond you as a lawyer, but certainly something to be aware of and would affect M&A deals locally. There are also, for foreign direct investment, there have also been challenges in certain jurisdictions. I think for certain sectors, challenges around foreigners doing business, with requirements that there has to be a certain threshold of local party involvement or locally incorporated companies. But also, I think Tanzania recently had regulation around foreigners not being able to be involved in certain transactions. So, of course, that would affect the foreign direct investment there. And increasingly, because of the peculiar nature of Africa, because of the peculiar nature of East Africa, the standard, this is an equity investment. This is, this is an equity investment, or this is a debt financing, may not work in the region. Increasingly, we've seen that there's need for a blended financing in the region. So, or taking out of a guarantee, against political risk or things like that, to be able to do business in the region. And this would require, as lawyers, us to be able to upskill, to educate ourselves on each of these areas, to be able to properly advise a client or to properly assist if you're on the vendor side or target side to prepare for a transaction in that regard. But also, as you conduct due diligences, to be able to advise, to be able to put in place mitigation measures. So I think critically, as a lawyer, one of the key things as lawyers, to be able to deal with this complex due diligence process is, one, to upskill, make sure you're knowledgeable. There's a lot of learning online, seminars, webinars such as this. To upskill and be able to advise, be able to assist your clients in to deal with the changes, the different themes. But also the other thing I think, and I think Catherine spoke to it, is as a lawyer in an M&A transaction, you must be organized. Many times, especially if it's a cross-border transaction, depending on which side you are, especially if you're lead counsel, there are many moving parts. It would require that you are organized. You'd have to draw up, I think you spoke of an approvals calendar that, we require approval from, if it's a financial transaction, maybe from the regular, banking regulator, we require approval from data protection office, approval from shareholders, approval from directors, approval from, the different layers of, so you need to have an approvals calendar, but equally you need a CP checklist. For these are CPs that would be required. This is when they would come in, and that there's nothing clashing at either point. So I think the long and short is, being highly organized. I think to manage to go around this, that's why people have all these weekly calls or midweek calls and things like that, but to be able to properly advise and to work with different advisors across regions, different advisors across sectors. If it's a cross-border transaction, sometimes you need to arrange calls across the different countries. If it's across sectoral or different advisors, you need coordinating between tax, ESG, tech, auditors, the lawyers, international counsel, local counsel, different local counsel across the different jurisdictions. So I think the long and short is, the need for order in managing a complex due diligence process, in managing a complex advisory process. But also, keeping up with the trends. For very long, the lawyers in Uganda have not had to bother with competition law advice, but recently we've had competition regulations passed or gazetted. They're not fully publicly available, but they're gazetted and they will require notifications. There'll now be a competition office set up in the Ministry of Trade. So that's something that will add another layer and a new advisory layer, but also, as my colleagues commented, there's now the COMESA notification guidelines for East Africa. The East Africa notification guidelines on top of the COMESA ones. So, adding another layer of advisory. So, that's another thing to be aware of and to manage, and would add to the already complex advisory layers in an M&A transaction. I think in a nutshell, those are some of the key critical areas that, as a lawyer advising, you ought to be aware of, but also how the influences of both European PE and China have affected the M&A landscape in the region and how we might be able to advise. My colleague Stephen spoke earlier about some of the exits that have happened. Much of the exiting we've seen has been to private share sales. I think there's only been one exit in the recent past in the region. That is Cipla Quality Chemicals, which saw the listing of a company as an initial public offer as an exit for in an M&A. But generally, that's how much of the it's not yet as complex as many other markets. I think I'll stop there for now, just keeping in mind the time and yield the time unless there are questions or interventions. Thank you.
Yeah, thank you very much, Jonathan, for that insightful presentation. Benedict, please, the floor is yours. Kindly be mindful of time.
Yeah. Thank you.
Okay.
Yes, I'm there. I'm just trying to share my screen. You can see my screen there?
Yes, we see the screen.
Yeah, sure. So thank you. And I need to appreciate, I think, Catherine, Jonathan, and the previous speaker, because so also by way of introduction, I'm Benedict Shabakaki, a partner to Victoria Attorneys Consultant here in Tanzania, but I'm also a chairperson to the East Africa Law Society Corporate Law Committee. Having said that, I have to appreciate, of course, the previous speaker, Catherine, Jonathan, and my late brother, who, of course, despite the fact that they've given the role to touch other aspects, but in one way or another, they've also touched a little bit about, legal consideration when it comes to major acquisition transaction within East Africa. And I also need to point out clear that I must, of course, also give a shout out to East Africa Law Society, because the recent transaction in the recent market, the way we see, we are seeing that banks are expanding, retailers company expanding. So right now, if you are talking about major acquisition, you may not single out specific country, let's say maybe Tanzania only, not speaking about Kenya or Uganda, especially for these international measure, which of course most of us we are dealing with. But having said so, I think I'll not waste time. I have only 12 minutes to speak. So some of the slides, I will make sure that I skip them because other colleagues of mine have already touched them. And some, of course, I'll also try to highlight in one another. So I'm going to speak about 5 issues. Number one, I will start to speak about the difference between share purchase and asset purchase. As most of clients, when they approach us, they may come with a big picture, whether rather they want to purchase a share or just a property within the company. So I'll also try to mention a little bit difference and what are the best practice. But I also try to touch a little bit practical point of view, not a theoretical one, based on the major acquisition which we've done here at Victor Attorney on issues to do with due diligence. What does it take? What are you supposed to do as a lawyer in a practical way? But I also speak about the art of warranties and indemnity to what is it that is so special you can do as a lawyer when it's come to drafting the warranties and indemnity. But lastly, I'll also speak the tips for smooth dealing, tips for smooth dealing of M&E. Okay, so starting by what make a major transaction successful, just a few highlights. For a lawyer, if you are dealing with a major acquisition, you need to make sure that you start early planning and preparation. But also, as my other colleagues who spoke earlier, you need to know, and that's the reason why, of course, I also congratulate East Africa Law Society, because if you have a major acquisition, which of course involve a company in Tanzania and in Kenya, there's no way you can say that you'll perform as a law firm here in Tanzania. You need to make sure that you also involve a local expertise from either Kenya or Uganda, because a lawyer from Kenya will have more relationship with other regulator there compared to a lawyer from Tanzania. And that's why I say you need to have a local expertise, but also you need to create a very good relationship with the local players. But the other issue is you need to make sure that your communication is in line and you're also transparent in terms of your initial engagement with clients, because normally we advise the way we also deal here with this kind of major acquisition here at Victor Attorney. We term them as projects. We don't just take an assignment as a single assignment, but rather we take an assignment as a project. But also you need to understand the regulatory landscape, as other colleague, of course, have said. And that's why I say normally an M&E lawyer is not a specialist per se. In Europe, of course, you may find other people, they call them an expert of merger and acquisition. But in our context of course, especially for East Africa, I would rather say you may be a corporate lawyer because, M&E involve a lot of areas, as you can see, I'll show you below. So you cannot call yourself an expert of M&E while, of course, the whole transaction is going to involve tax lawyers, it's going to involve auditors, it's going to involve people who are very confident with labor law, it's going to involve people who are very confident with corporate law in terms of maybe company law. So that's why I say the way you take the deal, you need to take the deal as a project and not you as a specialist of M&E per se. So what is it? So whatever clients reach to us, first of all, they come because for them, they are not lawyers or they don't have a background of law. They may just come to you and say, perhaps I want to buy a certain land, or I want to buy a certain, asset, or I want to buy a certain, IP or a certain, contract in a specific place. So the role of a lawyer here is now to be able to differentiate between the need of a client, whether you may advise the client to proceed with the share agreement in terms of SPA, or rather you may just advise the client to proceed with assets purchase. And these two are different and they have each advantage and disadvantage. So for instance, when it comes to share purchase, we normally, of course, that's where, of course, the lawyer will prepare a share purchase agreement. Of course, This will, I mean, we have other issues to do. They're there below in my slide, but I'll also show you before, of course, you even start with SPA. But I just wanted to, for colleagues here to understand the difference between share purchase and asset purchase. So the advantage of, for instance, if you are doing with share purchase, number one is the continuity of the legal entity. So rather, if your client need a certain land in a certain place, and that land is belonging to another company, now it's your role as a lawyer to to determine to a client whether you're going to to purchase it as an asset, as a land per se, or you're going to purchase it as a share. So you need to understand that if you purchase it as a share, that will have a going concern, which means you will have a role to maintain two companies here. But if you want to purchase it as an asset, of course, you have an advantage whereby you'll just take an asset and then the other company may decide to seize and you may proceed like that. Because here we are all lawyers, I'll just go to advantage and the disadvantage. So the advantage is that you have a continuity, and then the other advantage for a buyer in terms of share purchase is that the buyer can also acquire the brand, you acquire the customer relationship, and you also have a going concern. However, the risk and challenge when it comes to share purchase are when you acquire the shares, the buyer will assume all past and present and future liability, and that's where, of course, I'm also insisting when it comes to due diligence. But also, when you do the share purchase arrangement, you need to make sure that your due diligence is very heavy and you have all the checklists, which, of course, I'm going to mention below. While if you are doing an asset purchase, at least the advantage is the risk management is not very high, and also the tax plan. When it comes to tax planning and tax advisory, you may not involve a lot of energy because you are only talking about a certain one transaction compared to share, whereby you need to make sure that everything is in place. But the only risk here when it comes to asset purchase is that it is very complexity because it involves a lot. You don't see that? Okay, I'm told that my slide is not moving. Okay, let me see here. I'll just pick it up like this. Thank you. So when the other risk is that when it comes to asset purchase, you need to be very careful in terms of contract and license because you don't know maybe that IP which you are buying or that land which you are buying, it has also which kind of prohibition to the market. Now, when it comes to the general understanding of merger acquisition transaction, the first thing which you need to understand is to understand the deal. So you need to make sure that who are the merging parties, and this is very key. And I think also my colleague Catherine has also mentioned, because it's very key to understand are the merging entities a subsidiary company, are they a branch company, or are they affiliates? This will also give you a little bit highlight when you want to engage a tax expert or when you want to engage other lawyers in the team. As I told you, you normally treat M&E as a project. So normally you work as a team. So after understanding the merging or the acquiring parties, that's where now you understand in that project which you are going to proceed, who are you going to feature in that team. The other issue, of course, which is very key is ownership and control structure. As other colleagues spoke, this company now you may find that maybe they're holding company in Mauritius, but the only entity which is going to be acquired is only a single company here in Tanzania, or the other company is a holding company maybe in USA, but there's a single entity which is going to be acquired here in Tanzania. So you need to understand there, even before you've signed your engagement letter, who are those merging parties. What is the nature of ownership and control? What are the cross-border complexities which are going to be involved here in terms of multiple regulation, currency involved, legal framework involved? You need to understand clearly. And then once you understand the party in such transaction, the other thing before even you have signed your letter of engagement or your contract is to to know the structure of the deal. You know, is it a share purchase? That's where I'm going about. The way you ever said to you, as a lawyer, are you advising your client to proceed as a share purchase in terms of SPA, or would just advise your client just to proceed with asset purchase only? But also you need to understand, is this major statutory merger or just a mere joint venture? And also you need to ask yourself when you are structuring a deal, will it involve a full acquisition or just a majority, which of course will also form majority control, or it's just a minority investment in such structure? But also when you are structuring the deal, you also need to know the proposed consideration. Is it a cash? Is it in terms of share? Is it in terms of that transaction, or the combination of both? Because we have experience here whereby you can enter into a merger acquisition deal, but in terms of consideration, it's not only applicable in cash. Rather, they are going to merge, and they are going to merge, but the terms of consideration maybe is contribution to the machinery or contribution to other issues. So you need to understand the deal before you sign even an engagement agreement with the client. The other issue is to know the valuation of the deal. How is the deal being valued? And that's why, of course, other colleagues, they say you don't work alone as lawyers. Sometimes a lawyer, maybe if you're not a financial lawyer, you may not understand how to interpret books of accounts. But if you worked as a team or as a project with other expertise, maybe in tax or in finance, they may also tell you the realistic of the books of account, so that you can also understand before even you sign your engagement letter, what is it worth that you're going to deal you as a lawyer. But also you need to understand the source of fund. You know, is it that the fund will come from internal? Is it a debt? Is it external? Is it a shareholder loan? And this is very key, because I understand for both East African countries in terms of regional, we also have specific rules. For instance, here in Tanzania, if a major acquisition will involve a loan arrangement, you are supposed to make sure that the same is also registered with Bank of Tanzania. So you need to understand the source of fund, so that it can also give you a key highlight when it comes to due diligence. Also, you know, to know that who are those clients and who are you dealing with. And then the other thing, before you understand you have signed any engagement, is regulatory and competition implication, whereby you need to make sure that is the merger regulated? Does it fall within the threshold? Of course, I'll also show you the numbers between the East African country, but also you need to know whether it's a sector-specific approval needed. For instance, if you are dealing with the merger acquisition which involve banking, you know for sure you may need a sector-specific license. Or if you are doing with the merger acquisition with an insurance company, you know for sure that, for instance, in Tanzania, you may need an approval from a regulator. Or if you are doing with gaming and casino, you also make sure, because for instance, right now, we are handling one of the major acquisition involving casino. And to a surprise, if you read the law, you find that you are supposed to get a consent from the casino board even before you've gone to FCC or to the fair competition. So these are the key issues to understand even before you've given the client a letter of engagement, so that at least when you now start the due diligence, so when you now start to work with the client, you know for sure the level of project and the level of timing which you're going to use. So tips in this, when it comes to understanding the deal, is treat the deal as a project, as I say. Make sure that you are not alone, as other colleagues also spoke. You know, you may be a specialist in corporate law, but you may not be a specialist in tax law or labor law or an insurance law. So understand the deal. Once you understand the deal, that's where, of course, you may know that as a law firm, maybe this deal will involve this and this kind of people. There's a kind of transaction which, of course, in our firm, we also involve a litigation department, because you acquire a company whereby they have a lot of litigation, and each litigation you need to assess so that you can put in warranties and other condition which are going to happen in post-merger. So understand the deal will also tell you who are the team to be there. Sometimes maybe only labor people, sometimes only corporate people, sometimes you need to engage tax people, sometimes litigation people. But the other issue is understanding the scope of the deal, so that it can also help you when it comes to billing. because if you don't treat merger acquisition as a project, you may end up signing a deal, let's say only $20,000, and you may find that you take the transaction for whole year. As my colleague Jonathan spoke, most of time nowadays, some of clients, they don't prefer billable by hours. So they may tell you that upon assessing our project, what will you be your cap fee? So you need to be very clear. For M&E, for those clients who prefer, billable by hour, is a little bit easy, because as you keep going, you keep record the billable hours. But for those who prefer a cap fee, you need to be very, very technical. And then the other thing is pre-merger. As I told you, once you've already understand the deal, make sure that you execute a non-disclosure agreement. Of course, most of the clients, they may not even share to you any document before having a non-disclosure agreement. So this is common for all lawyers. Make sure that you map all the approval, third-party approval, regulatory, and notice. You create like an Excel sheet whereby whatever you perform, each aspect, you'll be, like ticking that this is already done. Identify conflicting and challenges in legal obligation. For instance, the revenue authority in your country, for instance, the regulatory authority when it comes to company registration. But also make sure, and this, of course, my other colleague, they also spoke, you establish a major schedule whereby it has a timeline, and whereby it also sometimes it has a specific person who is assigned to make sure that maybe this checklist of labor, this our colleague, maybe Catherine, will be dealing the checklist of tax law. Our colleague Jonathan will be the one who is dealing with. Then thereafter, you may conduct a due diligence. So when it comes to due diligence, it's also a very technical, because some of clients, they may involve you as a law firm just to do a due diligence, and then they may proceed with the transaction with other lawyers. So when it comes to the following slide, of course, is also going to mention the do's and don'ts when it comes to due diligence, but make sure that you identify the scope. So if a client gives you a due diligence, you need to make sure that, is it specific for corporate law? Is it cover the ongoing concern of the company, which of course include issues to be with labor, ongoing litigation? Is this also going to cover issues of tax? So you need to be very clear to identify your scope of due diligence before you even sign an agreement with the client. Then thereafter, you organize your team based on area of a specialist. So if a client, you acquire, let's say, a bank which also involve a lot of litigation, for sure in your team, despite the fact that you are the one who is a specialist or a team leader or in terms of M&E, but you may also have another 2 or 3 guys who are dealing with the litigation, so that they may also help you to prepare when it comes to and clauses. Okay. And due diligence. So a little bit, you have corporate record where MEMAT, shareholder agreement, issues whereby we enter into an updated MEMAT. All those are there. Annual returns are filing when it comes to corporate, with the respective registrar. You need to make sure that all the registers in terms of company secretary, member, registry, directors. In this normally is a very challenge when it comes to international merger acquisition. When this international company acquire, the small merging company here, for instance, in Tanzania, you find that a lot of companies, they are missing this registry, they are missing this, shareholder certificate, they are missing the AGM minutes. As if you ask most of the lawyers who handle this transaction, they may tell you, this is a family company, so we don't have an AGM meeting, we don't have a share certificate. So you need to make sure that when you conduct your due diligence, you highlight all those, so that when the other side of acquisition, they can correct them, they can correct, or if your client also decide to waive them, you can also put them in the indemnity or other clauses. When it comes to finance, make sure that, of course, you also review, you engage another expert in terms of consultant, whether it's a finance guy to review, taxes, to review financial accounting policy, And this is where normally most of lawyers, they do also a mistake, taking a project as theirs alone without engaging other accounting or other tax expert. And then later on, when the deal mature, you come to realize that you may end up being sued just because you did not follow the certain procedure. So you may find a lot of, in my slide, you may find a lot of issues which I've mentioned when it comes to finance. And then now there's another department which normally most of people, they tend to forgo, HR department. You also need to make sure that you do your own due diligence in terms of payroll, medical cover, whether the company use consultants or whether they also use foreign employees. What are the local regulation when it's come to foreign employee? My colleague also, Jonathan, has spoke, for instance, here in Tanzania. Maybe there's a major acquisition and maybe the acquirer is a member of foreign. Is it that they are going also to be given that permit, the fact that now there's a new regulation which is there? But also make sure that the license and permit, they have their own separate category in terms of when it comes to issues of due diligence. For instance, if you are dealing with a major, recent, of course, we were involved into a major acquisition when it comes to into tourism industry. So you need to have an expert in that area. If you are doing major acquisition in mining, you need to have an expert in that area who will also give you what to do when it's come to license and other issues. And then the other issues like material contract, make sure that you are aware of them. Compliance check, issues to do with anti-money laundering, issues to do with anti-corruption, sanction, ESG, other colleagues has already spoke, litigation history, and etc. Specific, when you do a M&E, I would rather recommend a lot of people also to be very careful in terms of land. So things to do with title verification, intellectual property, data protection and technology, and shareholders. So these are the very key. Things which are common when it's come to due diligence, which of course are red flagged for most of people, is number one, we find that a lot of people, a lot of companies, they don't have a complete, corporate record. So this is very key to make sure that you respect the same, and attend the regulatory matter and fine, so that sometimes you may advise the client, if you skip this, that this will be your penalties, or if you skip this will be your penalties. Compliance issues such as non-filing, you need also to advise your client in terms of if you don't file this will be the limit. Tax arrears and dispute and pending dispute. So if you manage to have all these records and a common flag, as a result, you may tend to go back to another company, which of course is acquired company, and the same will it's not the fact that you may cancel the deal, but rather it may result to price reduction, or other lawyer, they may say, let's have a conditional completion mechanism. So instead of saying maybe the transaction will complete after payment of capital gain tax, you may also put another warranties and condition. And that's why I say it's very key to have this due diligence report highlighted, and each one with its own implication. So there's in my slide, I've tried to go through the East African country and to show you in terms of notification. Of course, you may find it in my slide. My colleague from Uganda has also just said that recently Uganda, they've also passed the regulation, even though not in place. In East Africa, also Catherine has also mentioned that we have a new East African Competition Authority, regulation which has been passed, and they intend to start in November this year. So that is another thing which, of course, you need to look as a lawyer, whether that transaction has met that threshold. For those who are operating in COMESA, there's also other, but because I know there's a colleague from COMESA, I'll skip on that. And then what are the key to master transaction? So these are just a summary, which I've just highlighted, too easy for a lawyer who, would like to be involved in major acquisitions. So for instance, what are the critical common mistake which we normally see in this kind of transaction? Number one is insufficient due diligence. Maybe because you did not bill your client well, you also tend maybe to produce a report which is not well detailed. Overlooking on the legal obligation and the liability, ignore tax implication, which of course at the end of the day, A client may end up suing you if you don't have an insurance. That's another issue. Poor purchase price allocation, especially if you are doing with a group of company. So recently we were involved to a group of company whereby a purchaser will say that I have this cap fee for all these 3 companies. So you need to be very smart, and you also need to be to work with the accounting and finance expert, so that will be very easy for you to allocate purchase price for each company if you're dealing with a group acquisition. And estimating time, and that's why other colleagues of mine, they say make sure that you have a timeline. That was also a very critical mistake. And the other issue is weak identification in warranties. And remember, when it comes to warranties and indemnification clauses, this will only happen once your due diligence report was good. And that's, of course, I'll also go there because of time, regarding the art of drafting warranties and indemnity. So in summary, for you to be able to draft a good warranties and indemnity, the basis of it is coming from the due diligence report. Because the due diligence report is the report now which will tell you that maybe the acquired company, they don't have this license, maybe they've acquired previous. So for instance, you may find that there's a previous transaction which has been happened, and then the acquired company was not reported the same with the regulatory authority. So that will give you a big picture when it comes to indemnity, in a way that you may draft an indemnity clause which protect your client. What if now maybe the regulator come to do an investigation, and then they found that the previous 3 years transaction did not reported to, let's say, the FCC, in which of course they will result to fine. So you need to have clauses which of course you make sure that they'll protect your client. So those are the tips which of course I mentioned there. Be specific when it comes to warrant. Use qualifiers, cross-reference schedules and duration. Most of transactions which of course we are dealing with them, especially if you involve other international lawyers, they normally come up with their own, pre-drafted warranties and indemnity. And also other colleagues, they mentioned they use artificial intelligence, but make sure that you as a lawyer, you have a specific team or a specific counsel or associate who will be dealing with review those warranties and indemnity. Because in real sense, when it comes to warranties and indemnity, especially the level of the transaction which we are speaking about, the international transaction, international, they have a tendency of, believing that they are better than, the regional lawyers. So they will draft those indemnity and then give you as a local lawyer just to perfect them and make sure that they are good. Other recommendation when it comes to warranty indemnities is make sure you have the closing deliverable and condition precedent. Normally create a chart so that, because M&E involve a lot of issues, so that at the end of the day, when you close the transaction, you know for sure that these are my checklists, these are the indemnity, and these are the conditional precedent. We said you will not sign before we have this license. We said you will not sign until we have this approval. So make sure that you have the same. Make sure that also your workaway clauses or radio actions, price reduction or fluctuation, because normally sometimes these indemnities and warranties, they may also end up determining whether the price will be reduced or there'll be a fluctuation in terms of currencies if you use separate currencies. Issues to do with extra accounts, holdings. Make sure that those are also reflected in your transaction. I'll skip this one because a colleague of mine, they've also spoke about, post-closing and integration challenges. But I'll just go direct because of time on tips for smooth deal. So normally, because we've dealt with a lot of transaction here, we also have our checklist here at office. We only have 3 issues. Number 1 is document. Number 2 is collaboration. Number 3 is communication. So when it comes to document, for you to have a smooth deal, make sure that you create your major schedule. Make sure that you have a folder for document for each specific sector. Make sure that you track flow each of the documents. So for instance, I'll give you an example. We've just completed the major acquisition 2 years ago, but just few days ago, a client is now asking for a certain document, which of course they were closed past 2 years ago. So for some time, you may also close the deal 5 years ago, and then let's say the tax authority in your country now, maybe they also want to investigate or to audit that major acquisition. So if you don't have your folders reset well, you may end up finding that you are now performing another billable hours, which of course is not even billable, because sometimes this client will only work with you in a retainer basis, and then you may not say to them that I have to bill you again for me to trace a certain document, which of course is a transaction which you've dealt yourself. Collaboration, I mean, we are all lawyers and understand most of these deals, the big deals are taken now by international firms, the Big Four. But if you are smart enough to make sure that you collaborate with good accountant, good tax expert, I'm sure that even our law firms are also going to be there to compete with these Big Four to make sure that we also take these major deals. Prioritize stakeholders engagement in terms of employees, regulators, and make sure that core counsel in transaction. The fact that you're a good corporate lawyer or commercial transaction, that does not make you a good M&E lawyer. Make sure that you also collaborate with other people from your team. Other issue, which is in the checklist for most deal, is communication. But this, of course, my team, the other colleague have already spoken. Make sure that in internal you have a weekly meeting. Be flexible. We were involved in the transaction whereby other lawyers, they are it's an international law firm from America. Other lawyers, they are from Australia. So you need to be flexible. You may not say that me, I'm a 9 to 5 guy, or I may not work overnight because it's just a transaction. Normally, this kind of transaction, if involve border or cross-border transaction, sometime in the midnight is the time where, of course, you have a joint call. So you need to be flexible as a lawyer. And lastly, at the outset of both parties, you need to understand the process, because if you are 5 lawyers dealing with a certain transaction, there reach a time whereby the team lead will not be there. So make sure that even the other lawyers or junior associates, they also understand the deal, so that at least even if you're not there or even if you're on your holiday, at least the transaction will move ahead. I'll end up by saying a greater merger and acquisition lawyer is not just a legal advisor, but a deal maker, because you are striking the balance between protecting the interest and closing the transaction. Sometimes you may find that after you've done your due diligence, the company is very weak when it's come to compliance. But you may not tell your client pull off because maybe this company has a lot of liability or has a lot of weakness. Your role as a lawyer is to make sure that you become a deal maker by making sure that you may protect your client with warranties and conditions post merge, instead of telling your client or advise your client pull off. So I think for that, in the matter of time, maybe the rest of issues I may contribute during the Q&A. Thank you.
Thank you very much, Mr. Benedict. Let's have Dr. Willard. I'm not sure whether he's still here. I understand he was going for another engagement, but if he's present, we could hear from him before we go to the Q&A.
Good afternoon to all. So indeed, Dr. Mwemba, my CEO, was to present. Unfortunately, he has had to rush to another meeting, so I'll be sitting in his place. My name is Ali Kamanga. I'm a manager for mergers and acquisitions at the COMESA Competition Commission. I have just switched on my camera for avoidance of doubt that it's not AI that is presenting. Then I'll switch it off for the rest of the presentation. We are living in very advanced and digital world where anything can happen. And I hope I'm audible.
Yes, you are. We can hear you.
Thank you so much. I know that we are strained on time, but I'll quickly just go to the presentation. So indeed, the presentation by my CEO was to focus on regional competition oversight in Africa, particularly the role of COMESA in shaping fair and efficient cross-border mergers and acquisitions. I'll skip the outline of the presentation and quickly just to go to my first slide. By way of introduction, I'm very sure, and I've heard from the panelists, that you are aware of the COMESA Competition Commission, which is a body, regional body established under the COMESA Treaty. And if you read our regulations, the commission is established pursuant to Article 6 of the regulations. Of course, being a regulator, our key aim as a commission is to promote and regulate competition, or rather encourage competition. And the focus is on restrictive business practices. And most importantly, I would say that major regulation for purposes of this engagement. Ultimately, as is the case with all competition regulation, it is for the benefit of consumers. Apologies, I seem to be okay. By continuing the presentation, apologies for that. Just to note that in terms of the call functions or the role of the commission, indeed, we do have the power or function to monitor and investigate restrictive business practices. As well, it is the role of the commission to regularly review competition policy. As you will appreciate that markets are dynamic. These days, we do talk of digital markets, which always raises a question from us regulators as to the extent to which our law, as they currently stand, can regulate such markets. So review of regional competition policy, as well as review of the regulations, is also a key function of the commission, and we indeed do and are doing that. As well, being a regional competition authority, I know panelists have hinted on the role of national competition authorities, such as the Competition Authority of Kenya and others. As a regional competition authority, one of a special working relation or special circumstance the commission has is to also work with national competition authorities at member state level. And to this end, what is worth maybe bringing to this August House is the fact that not all competition authorities are at the same level of development in terms of enforcement and implementation of the law. I know a panelist did bring up Uganda, which is one of the recent member states that have enacted the competition law. So indeed, as a regional competition authority, it is one of our functions to ensure that we engage such national competition authorities to ensure that there's harmonization between national laws and the regional competition law. Most importantly, to ensure that the timelines that the panelists, the lawyers, were hinting on, but also the businesses, are not affected by different competition law enforcement regimes in our markets. Moving on, what is also worth highlighting is the role of the commission in cooperating with competition authorities at national level, as well as providing support to member states, national competition authorities, because what is peculiar and special for a regional competition authority like ours is that as we enforce, we do have to work with these national competition authorities. So cooperation is a given, as well as support, but also capacity building of these national competition authorities is very important, all for the benefit of the business community, so that we manage those timelines that kept on coming up. I think development and dissemination of information obviously the decisions that we issue as a commission, as well as if we engage into review of our law, this is information that has to be brought to the public because the legal fraternity or the lawyers, you need to know what is currently pertaining if you have to ensure that that deal that you're working on is fast-tracked. Lastly, it is also one of the a key function of the commission in ensuring that we also engage with other authorities, other regulators in exchanging, information that will facilitate enforcement of competition law. Just quickly to move on to the next issue, in relation to why then is there a regional competition authority? The COMESA Competition Commission is there to ensure that in the context of mergers, that the deals that are being concluded out there are good for the market. In our cycle as regional competition authorities, we do make reference to ensuring that such mergers do not have an effect on trade between member states, or in other words, they do not limit entry of businesses in other markets beyond national markets. This is just an instance of restriction or effect on trade between member states. As well, I did mention that we want to ensure that our consumers, their welfare is not eroded by virtue of major transactions that are taking place out there. Obviously, where transactions raise competition concerns, the Commission has got the role or the mandate and powers to ensure that such negative major transactions to the market are remedied and even prohibited. I think as I ran through my slides, it will become obvious that we have indeed put across remedies to merging parties, including prohibiting transactions which were those likely to raise competition concerns. Moving on to the next slide, is just to quickly highlight that there's always a question as to why businesses should go to a regional competition authority. Why not, just go to a national competition authority as well? There are issues around the costs of making filings for these major transactions. What you should appreciate from a regional competition authority such as the Commission is that obviously the jurisdiction is to handle cross-border mergers. So transactions that are only limited to the national space or to the borders of a national a member state, those transactions may fall outside the jurisdiction of the Commission. I've used may because others have fallen within the jurisdiction of the Commission. But for cross-border mergers, definitely those will be mergers that the Commission would handle. What is the benefit for there being a regional competition authority? I think the obvious one, which I know a lot of lawyers on the call may appreciate, is the fact that there is that elimination of multiple filings of cross-border mergers, such that a decision that is issued by the COMESA Competition Commission would be a decision that would be applicable and enforceable in all the member states where these businesses have got operations. Then that brings us to the issue of the COMESA Competition Commission being a one-stop, major control regime. Oftentimes, at certain national jurisdictions, there's always a point, or there are always considerations beyond competition and market-related effects of transactions that may be the basis for approving major transactions. Under the COMESA Competition Commission, just to highlight that the Commission's considerations are more on the competitive or rather competitive effects of major transactions and not necessarily on non-competition related matters, which is also a benefit and an incentive for businesses to interface with the COMESA Competition Commission. Although it is a cost to doing business, the cost being payment of major filing fees, just to indicate that as a regional competition authority, such fees would also then be lessened in a way that businesses would make a single filing that would be applicable across national jurisdictions. But as well, you will recall that in the few initial slides I did indicate on our collaboration with national competition authorities, which collaboration has got an aspect of capacity building. So the fees which are paid for such major filings, they also go towards supporting that cause. Moving on, I'll try to be quick. I did mention that indeed, as much as the Commission has got jurisdiction on cross-border mergers, what is also very important to point out is that it is not all major transactions that are cross-border that would fall within the jurisdiction of the Commission. That said, the Commission has, under the regulations, Article 23, has got a provision that where transactions meet regional dimension, or where the parties both operate in 2 or more member states, or either of the parties has operations in 2 or more, the Commission may start considering such transactions as transactions that are cross-border and notifiable to the Commission. But further to that, you may be aware that the Commission also has put in place major notification thresholds, which then narrow down the transactions that would be notifiable to the COMESA and a Competition Commission. And these thresholds I've just highlighted here on this slide to first say that there are so many transactions that are happening out there. As a COMESA Competition Commission, as a regional competition commission, our role is to ensure that we are also not delaying business, and we're also not focused on looking at each and every transaction, because not all of them may have that effect on trade between member states. That then brings in thresholds. And our thresholds, as you may be aware, they are well captured and presented under our Rule 4 of the Rules on the Determination of Major Notification Thresholds, which is split in 3 limbs. I think for the interest of time, I will not dwell so much on this, just to note that the key point would be to consider the combined turnover of the merging parties, which should at least be $50 million derived in the common market. This is whether turnover or asset value, whichever is higher. As well, the Commission would consider the magnitude of operations of each individual party to the transaction and confirm whether each of the parties individually derive at least 10 million in the common market. If that is confirmed, we would also want to consider the extent to which both parties to a major transaction have got operations in a single member state, such that if those operations are to a tune of 2/3 of their turnover or asset values, whichever is higher, the Commission may ask the question that to what extent would this transaction be regional and not national and pertaining to that country where both parties have substantial operations. The rules on thresholds, just to note that they are cumulative, so the Commission would consider the whole Rule 4 and confirm whether it applies to a particular transaction. The last point on this slide is just to note that even where a transaction does not meet the thresholds, the Commission has got powers to invoke and request notification of that transaction to the extent that there are clear concerns or likelihood that the transaction will raise competition concerns. And the Commission has indeed invoked these powers in the past, particularly in the Uber Careem transaction, which generally affected the Egyptian market, but still the Commission invoked its powers and reviewed the transaction as a regional cross-border transaction. Moving on and quickly the thresholds having been put in place, and if the thresholds are met, the Commission is further guided for notifiable major transactions to levy a fee, which is calculated as 0.1% of the combined turnover or asset values of the merging parties derived in the common market. The fees are capped to a tune of $200,000 US. So the fees will never be levied beyond $200,000 US. Again, major review and major notification is not a tax on business, but it is the fee. It is to facilitate the review process, but ultimately to ensure that our markets are competitive for the benefit of the consumer, but also the businesses, competitors of those merging parties. The COMESA major control regime is non-suspensory, so parties may, although at their own risk, implement a merger transaction without having obtained approval from the COMESA Competition Commission. However, if parties do implement and following the Commission's review, that transaction is concluded to be not good for the market, and for instance, a prohibition is warranted, the Commission will invoke its powers, and this risk may be on the parties. It's just to flag out and put it out there. As a COMESA Competition Commission, obviously, we are there to facilitate business. I paid keen attention to one of the panelists who I think spoke about timelines for the completion of the deal. The Commission also anticipates this, and to this end, we know that not all businesses may be aware of the COMESA competition regime. Not all businesses may be sure that their transaction is notifiable, whether the thresholds are met, or what are the procedures. So the Commission does allow for pre-notification consultations where businesses, the lawyers, may approach the Commission just to get information on possible notifiability of certain major transactions. Where major transactions are not notifiable, the Commission may also give the businesses comfort that they may proceed with the transaction because it is clearly not notifiable, and the Commission does issue comfort letters. In our role as a regional competition authority and ensuring that major transactions are implemented smoothly, but there are also no gaps. The Commission has also, as I said, this role of engaging its member states, which I should say majority of which are also in the East Africa region, whereby in the review process, we have to engage member states as an obligation to ensure that we collect and solicit the relevant stakeholder views, which will inform decision-making on these major transactions. I'll not dwell so much on this one. But I think in the next slide, and in the spirit of engaging member states and the markets, the Commission also does conduct joint merger investigations with the national competition authorities. This is, I think, to ensure that we are thorough in our review process, and we solicit views from relevant stakeholders who are likely to be affected by such major transactions. I think this next slide is more for myself and my colleagues as we sit down and investigate. Perhaps I should not pay much time on it, and so is this slide. But importantly, I wanted to highlight, in the interest of time, the major outcomes of the major review process as a regional competition authority. So indeed, the Commission may declare a merger to be one that is not likely to raise any competition or public interest concerns and give an unconditional approval. Where the Commission has got concerns, obviously we do issue conditional approvals, whereby the Commission would impose remedies on remedies or conditions on such transactions, the basis of which a decision would be issued. I've just highlighted notable decisions the Commission has issued in the recent past. For instance, in the Heineken-Distell merger, where the Commission, as a condition, put a divestiture requirement on the parties, and subsequently a divestiture decision was also issued. The links are active here, so once we share the slide, colleagues should be able to access the decisions on our website. I also did mention the prohibition as one of the outcomes of major review, and indeed the Commission has prohibited the AkzoNobel merger, AkzoNobel Kansai Plascon major transactions, particularly in relation to selected markets. I believe it was Zambia, Kenya, among which the Commission prohibited implementation of this major transaction in identified relevant markets. Again, decision is accessible on our website. Obviously, remedies are put there to ensure that the Commission's identified concerns in major transaction are resolved, and as well to mitigate any identified public interest concerns. This is just to flag out as to why we would want to put remedies. In imposition of remedies or conditions, the Commission is always mindful as a competition authority that the remedy should address, it should be major specific, so address the identified competition concerns in that merger. There should be proportionate, proportionality principle should be a consideration in putting across such remedies. But also, most importantly, as an authority, we want to have remedies that are effective. So they should address the problem in an effective manner. They should be practical and not burdensome on the Commission and the parties. I think this may be also information that is known to the audience, but just to mention that the Commission's consideration of remedies does fall on either whether or not to impose structural remedies or behavioral remedies, both of which have got their, benefits, and, others have got their costs in terms of the commission monitoring in the case of behavioral remedies. Structural remedies, we obviously from theory are told that these tend to be easy to monitor, and then they'll be more effective, in the market. As I, go towards the conclusion of my presentation, just to note that in the interest of business, the Commission is mindful that time is money for business. So our regulations have clearly provided for 120 days within which the Commission should issue a decision. Of course, with the possibility of extending that timeline if in sparing and selected circumstances additional time is required for the review, the Commission may seek an approval from its board. A key point that I thought I could also bring up in this slide is to say that obviously where a decision has been issued and any party is aggrieved with that decision, the law has provided for an avenue for appeal, by any party who is, not happy with the Commission's decisions. And I think for the lawyers, this may make a very good reading. The Commission has also put in place, issued, appeals board procedure rules, which guide on the process on how one can go about appealing the decision of the Commission. It is important just to align trends in terms of how the Commission has been faring since its inception in 2013. So the Commission has reviewed over 470 merger transactions, which are accessible on our website. So you may access our decisions from the website, which may be very good, case precedent from the region in different sectors. I did speak of conditional approvals. The Commission has issued as well prohibition in one major transaction. And as well, the Commission collects major filing fees, which support its, major review process. This is just to appreciate that as a common market, COMESA, common market for Eastern and Southern Africa, the major transactions that have been reviewed over the last decade have affected these countries. You would see here Kenya is one of the prominent member state of COMESA, where most of these major transactions are taking place. And obviously you can see from the trend that the other countries that are also affected. You may notice that there are countries here whose numbers are not as much. This is where I raised the point of, the Commission's function of, engaging such markets, such authorities, so that the competition culture is grown and developed, so that we rid the market of, this anti-competitive conduct. As a Commission, we also take very keen interest in some of the prominent sectors that these major transactions are happening. And this is just a show of some of those sectors. Lastly, is a point of collaboration with other authorities that are relevant for enforcement of competition within our region. And in this slide, we're just highlighting that as a Commission, we are aware that the East Africa Competition Authority is indeed to start receiving major filings very soon. And knowing that markets are indeed cross-border, what happens in Tanzania may be, in terms of market development and competition, may be things that the COMESA Competition Commission should be aware of. So in the context of collaboration, we also collaborate with the EAC, the Competition Authority, in terms of exchanging information, on developments in the competition and consumer protection space, policies and law development. We do conduct joint workshops, studies, as well as investigation over measures and restrictive business practices. But also our collaboration touches on how to best appreciate each other's rules for the sake of the market. And you may access our MOU on the website, which has got more detailed, thinking around how we should work together. This is the end of my presentation, which will be shared, and I thank you very much sincerely for your audience. And I pass my apologies from my CEO, who would have loved to be here. Thank you.
Thank you very much for that deep discussion. We are slightly out of time, but there are a couple questions that were sent to us through the Q&A panel, and I'm going to the panelists to address them as we wind up the discussion and call it an evening. The first question was directed at Catherine, and it goes with regard to the recently published notice from EA Competition Authority of comment of receipt of notification of mergers and acquisitions with regard to cross-border effect. What takes effect between the partner state law and the East Africa community law in case of conflict between the two in cross-border mergers and acquisitions? This question is directed at you.
Thank you. I'll take up the question. So what I've understood is you're asking about what will happen with the conflict. If you check the headlines, you'll see that countries like most of the competition authorities within East Africa have actually signed MOUs with EAC on how this will be done. And therefore, they've signed MOUs on how they will collaborate. The only other complication that will be there will be, especially in regulated sectors where you'll still need regulatory approvals when it comes to M&As. But what is expected is that the East African countries will come up with an MOU, will agree with an MOU with the EAC so that it's seamless and one-off, and it doesn't conflict with, as you pointed out, the individual states. And I know some countries like Kenya, the MOU is already even publicly available. If it answers your question. Back to you, Leon.
Okay, thank you very much, Catherine. The next question that was sent anonymously: how would you structure a share purchase where one of the shareholders is a sanctioned individual or from a sanctioned country, and the buyer's company policies or the policies where they are from, but there's something wrong with the language here, but is asking whether there is a workaround in case there are sanctions. I am not sure who's going to take this question, but I need a volunteer from the panelists to kindly respond to this query.
Leon, would you repeat the question? I don't understand clearly. What is it about?
They were asking how you would structure a share purchase where one of the shareholders is a sanctioned individual or from a sanctioned country, and the buyer's company policies or the policies where they are from, are they engaging with the sanctioned individual? Basically, I think they're asking if the policies by a transaction between, if you're considering a merger, a regional merger, say Uganda and Kenya, and then there are sanctions against Uganda and the policies of Kenya bar Kenyans from transacting with Ugandans. I think that's what the question was asking about. And they're asking whether there is a workaround around the problem.
Oops. I think that's the question which will need more legal research rather than a direct answer. I'll be happy if the participant will send me an email. I'll be happy to assist him on that. Once I understand the broad picture of the question. Thank you.
Okay, the next question: how can parties best balance tax efficiency with regulatory compliance, particularly around capital gains tax, transfer pricing, and competition law considerations that increasingly affect deal value and timing? Yes, I still need a volunteer from the panel to respond to that query.
If I may take that question, I think, Leon, that of course will depend on the level of transaction, because we have dealt with one of the transaction whereby if you are trying to look on it on point of it, especially when it's come to some of these other East African countries, their tax law a little bit, some of the provision are a little bit great, like here in Tanzania, to the extent that in a certain circumstance, in terms of major acquisition, you may go to a certain tax consultant. They'll tell you that maybe the capital gain tax will be 20% for a foreigner. You may go to other interpretation for other lawyer or other tax consultant, they may tell you it's a 30%. So I think when it's come to issues of tax exposure, fee to be payable for notification, you may need detail, and also you may need now to see with the kind of transaction. For instance, the recent transaction which you dealt with, the only question, of course, which we'll ask clients is whether the shareholders, the outgoing shareholder, are they, for instance, resident for the purpose of tax? Are they filing returns? Because if they don't file returns, you may end up, you may end up interpret the law in such a way that they're also supposed to pay, 30%. So there's a way to go around, but I think will depend on content to content. Yeah, that would be my position.
Okay, thank you very much. This next question is for Mr. Ali. Mr. Ali, one of our listeners from the audience, says, "Dear Ali, thank you for the informative presentation. How many unlawful mergers has your division under COMESA handled, and what was the outcome on your desk and the compliance behavior of the mergers?"
No, thank you very much. That is a very important question. And just to quickly answer, so indeed, you will recall from the presentation that I did mention that COMESA is a non-suspensory regime, major control regime, meaning that in principle, merging parties may choose to go ahead and implement a transaction, and the Commission would not necessarily go after those merging parties for implementing without an approval. So that's the first point. But in the COMESA competition regulations, there is a requirement that any party to a notifiable merger should or shall notify the Commission as soon as it is practicable, but in no event later than 30 days of the party's decision to merge. So what we have in our law is that the moment the merging parties sit down and agree that we want to engage in this merger transaction, from that day, they have got 30 days to within which to approach the Commission and complete a merger filing. If they do not do that as merging parties, it is considered that they would be in contravention of that particular part of the regulations, which is Article 24(1). And now to answer your question is to say that yes, the Commission has handled two major transactions where merging parties were found to have approached the Commission beyond these 30 days to make a complete merger filing. So the Commission then sanction the parties, and the regulations say that if you don't approach the commission within that stipulated time, it is a sanctionable, it is an offense and it is sanctionable, and fines may apply. So in the Helios Towers Airtel merger transaction, which is available on our website, the commission fined the merging parties around $101,000 for that contravention. As well, in the SABIC ETG merger transaction, parties were fined around $314,000 for not adhering to that requirement. So I think that is how I'll just clarify on this point. Thank you. And then maybe while I still have the floor, and very important, the commission is in the process of reviewing the regulations, which will come, revising the regulations, which will come into effect very soon, where one of the key new provision would be a suspensory regime, whereby parties will not be will be required to seek the commission's decision before they go and implement the transaction. So there's that major shift that the lawyers should be on the lookout for very, very soon. Thank you. Let me stop there.
Yeah, thank you very much, Ali. That was very, very helpful. And now, ladies and gentlemen, the time allocated to us has come to an end. I would like to thank all the participants and our panelists for their insightful presentations. The presentations will be shared with all of us in due course. God bless you, and we look forward to seeing you next time. At this point, I'm going to invite Gabriel from the Secretariat of the East Africa Law Society to kindly take over.
Incredible. Thank you, Leon, and our esteemed panelists for that very awesome session. It's been quite thought-provoking, and it's one of those sessions that you want to go on and on and on. And on behalf of our entire Secretariat team here in Arusha, Tanzania, our CEO, Mr. David Sigana, and our President, Mr. Ramadan Abubakar, would like to thank you all for tuning in for this session. And very, very special thanks to our eminent panelists, Ms. Catherine Kariuki, Mr. Ali Kamanga, Mr. Benedict Shabakaki, Mr. William Kasozi, represented Ms. Alexia, who is standing in for the CEO of COMESA Competition Commission as well, and my good friend, Mr. Leon Amuthere. Thank you so much for that wonderful session. We look forward to hosting you again and again, ostensibly at the annual law conference in Addis Ababa this year. If you've not yet registered for the annual conference, please note that the East Africa Law Society annual law conference will be happening from the 26th to the 29th of November 2025 in the heart of Africa, in Ethiopia, Addis Ababa. So you register for that. We'll be having discussions of this nature, and this time it will be physical, so you don't want to miss that. Also, just to let you know, we have our in-house council convention happening from the 28th and 29th of August 2025 in the beautiful city of Kigali, Rwanda. If you have not registered for that convention, please register and come join the biggest a gathering of in-house counsel in East and Central Africa. You do not want to miss that for anything. Now, friends, this week on Thursday, we also have another very interesting webinar session that I believe will captivate you. And this week we'll be looking at another panel. And so you watch out for those details on our different social media platforms. It will be issued out shortly. I will be discussing mastering arbitration clauses in modern contracts. strategies for flexibility, enforceability, and effective dispute resolution. You don't want to miss that for anything on Thursday afternoon. So from us to you, we wish you a very lovely day. Be blessed and keep safe, hydrated. It's getting hot out there. Until we meet again, goodbye.
Goodbye. Thank you.
Goodbye.